Good evening. This is Duane Lowry for the DPP Grain Desk on Sunday, November 18th. It's currently 11:53 in the morning. The outlook tonight, I'm not sure there's a whole lot of factors here that are going to be driving the opening calls, I think, other than Friday's price performance in the grain trade. Going back to Friday morning, we talked about the window of opportunity for the bears rapidly closing and questioning whether we should embrace Friday's overnight weakness and the early morning negative tone around the trade. I strongly felt that we shouldn't embrace that weakness. I felt that we were getting ready for a major turn in the grain trade, and I think that by the time Friday's close rolled around with corn closing higher, wheat and beans firming up off of their early morning lows, I think there's been a change in tone in the grain trade, and I think that's driving the discussion this weekend, and I think that's going to be the initial focus here tonight. Mideast has escalated quite a bit yesterday on Saturday. I'm not sure this is a continual escalation event, and I think that may have been part of what was behind supporting the crude oil market on Friday. But we've talked about for a few days how the outside markets were poised for some sort of an upturn, and I think that may still be the case. I think that may tend to support commodity prices as well as a backdrop, but certainly not the main driving force. Weather, U.S. weather is not very important at the present time. The plains still do not have much for precip in the forecast, but the window of opportunity to impact the crop this fall is pretty much closing, and we're going to go into dormancy. Obviously, any winter precip will be welcome to build soil moisture, etc., whether that's in the Midwest or in the plains. But impacting the wheat crop at this fall, the opportunity is pretty much in the past. It's interesting to note that weekly crop ratings on wheat for this time of the year is some of the lowest on record. But there's, again, I'd caution that there's not a strong correlation between crop ratings at this time of the year and final wheat output. But it is the backdrop that will be, the bulls can look to at any time here during the next a few months through the winter period. I think it's also important to point out that we do not lack bullish fundamental storylines for either the wheat or the corn market. It's not difficult to create a bullish fundamental spin, and it's not been difficult to create that at any time during the last few to several months. But I think it's important to point out that what we need to kind of do here is look at things from a little bit step back view, a little bit bigger picture view. And I want to focus here on corn here to begin with. Normally I'd probably talk about wheat, but let's talk about the corn market. We know that the market was extremely bullish during the summer, looking at a small crop. The reality is the crop ideas continued to get smaller from August forward, but price action peaked, and prices peaked by mid-August. Prices have been in a decline basically since that time for different periods of sideways trade and whatever, but largely in decline. I think it's interesting to note that we had a September lows that were made just before the September stocks report. The market broke pretty hard into that period, probably $1.40, $1.50 off of the August peak. The market liquidated pretty hard through that period towards the end. But after that September stocks report came out, the market opened sharply higher, and it quickly went to limit up values. And then we spent the next 30 days where trader sentiment was looking to buy breaks, thought the seasonal lows were in. We're getting, quickly revamping bullish strategies that they were forced to exit before that report, quickly reestablishing a lot of seasonal bottom picking activity going on, and all for probably legitimate and the right reasons, and they all had a solid fundamental footing to base that idea on. The problem is the market didn't go anywhere. From the 1st of October to the middle of November, the market was basically going sideways. You spent most of your time in probably a 15 or 20 cent range on a closing basis. And then here just in the last several days, the market took a break below that level, and we got sentiment last week pretty bearish. By the time we got to, we started the week early with quite a bit of a negative outlook, and by the time we got to Friday morning, the trade was quite demoralized. A lot of long positions that had been put on during the month of October had been liquidated. Chart points had been violated, moving averages, whatever excuse they wanted to use, but the sentiment was extremely discouraged. And so the market accomplished a lot of liquidation. I had for quite some time been expecting these September lows to be violated, largely for the sole purpose of creating this liquidation activity. But as I pointed out on Friday morning, with beans breaking basically $2 in a short period of time, in about 7 or 8 days, for the corn market not go down and make no lows in that period, that was discouraging if you were trying to be bearish corn. And I strongly warned on Friday that we shouldn't be embracing this last round of weakness, and the window was closing on the opportunities for the bears to make a push below these September lows. So then we end up Friday getting this reversal up activity, and I think that when we take a step back view, I think what we've got here is a corn market that made the exact seasonal low tick at the end of September, just before that September stocks report, but has been completely unable to get anything going to the upside since that time frame. And then we had another mini liquidation break here last week. Now the market is relatively clean. We still have some liquidation to experience as we go into first notice day of December, and maybe that subdues things to some extent this week. I don't know, I got mixed ideas on it from that type of a micro perspective. But on the bigger picture, we are now getting ready for a winter seasonal rally. And I think that the mistake was going to be if we underestimate how far that could go and how quick we might go there. The contract high in March corn is just under 850. You're at 730 right now. I think the upside target for bulls at the present time is going to be some sort of a test or a probe of that contract high, which also happens to correlate closely with the spot continuation chart of what the high in the corn market has been as well. So I think there's going to be a challenge to see if the corn market can get up to that level sometime between now and the 1st of March. I don't think that's an unreasonable price target here at all, but we may need a little bit of fundamental input from South America or whatever, which is not an unreasonable possibility to get either. So the point here is you've got probably a $1.20 upside in corn. You're probably not going to violate Friday's lows in corn, which is, you're 20 cents off those lows right now. So if you're a user or somebody that has a need for ownership in corn, you got to be looking at quickly getting involved here. If you're a producer and looking for a place to make sales and you've been discouraged by recent price declines and wish maybe you had more sales in the books or whatever the case may be, or you're looking to price 2013 production, the good news is I think you've got a few months here where the market is going to give you more opportunities. I think so while we're at the infancy of this winter rally, it's important to set the foundation that these are going to be opportunities to make sales. We are not going to experience a corn market that goes up for months and months. We are going to experience a market that has a notable, strong seasonal rally during the winter. There's going to be a lot of question about whether we can get enough corn acres next spring. There's going to be people looking at all the soft red winter wheat acres and the likelihood that they'll go back into beans, and that'll reduce corn acres. There'll be ideas that a lot of guys who had corn on corn last year didn't perform as well in the drought as people who were in more of a corn-bean rotation, and the beans outperformed the corn in terms of profitability. And while that's not been the case over the last several years, we always tend to remember the most recent year as having the strongest influence. And I think there will be some people that will argue that some of the corn-on-corn acres will switch back to soybeans. So it's going to be difficult to get some of the large 2013 corn acres that the market thinks we're going to get or feels that we need to have. And I think that argument is going to be playing out over the next few months as well. So the corn market is well poised for a rally. It's poised that this could be a relatively quick rally, and the target's going to be contract highs in the market, which is like $1.20 plus higher in the old crop months, and the new crop won't perform as well. Spreads will tighten, etc. But that's the type of rally potential that you're looking at. When we look at the wheat market, I'm not sure that we know what the right storylines are going to be here. On the bear side, you can talk about large soft red winter wheat acreage. On the bull side, you can talk about declining global stocks from where we've been, but still arguably adequate or plentiful. You can talk about some problems in northern hemisphere wheat, U.S. plains hard red winter wheat, certainly go into dormancy under dry conditions. This can all be alleviated by spring. We don't know, but that's an area of concern. You've got areas of concern in parts of the former Soviet Union area. You've had problems with production and crop size and projections in Australia. You've had some concerns about Argentina. I don't know the seriousness of these concerns, but you've got a backdrop of fundamental storylines that have at different times been supporting the market and are going to be quick to support it again. Wheat market basically since July has traversed in a largely directionless trade ever since July till present. The last 6 or 7 days we had a washout that took the market down probably 80 plus cents, 90 cents in the wheat market. And this is after a period of time during the month of October where a lot of longer term traders decided they wanted to be bullish wheat for a lot of these global fundamental storylines that I touched on briefly, and there's a lot of speculative length added. Well, in the last 7 or 8 trading sessions, we completely flushed those out. We've made the lowest price levels we've attained since early July. These spec positions were washed out and cleansed, and once that job is accomplished, I don't know if there's reason to expect new or aggressive new short positions or more selling energy. So I think there can be an abrupt turnaround or an abrupt ending of the price declines we experienced over the last several days. As far as upside potential in wheat, I don't think we know what that is. I think a lot will depend on how we come out of the winter season in the northern hemisphere, but contract highs are basically $1 away in wheat. We talked about the upside target in corn about being $1.20. If you look at wheat-corn spreads, I think you can make an argument that wheat will need to lose to corn. I think that's a reasonable argument. But even if wheat loses 40 cents to corn over the next 4 or 5 months, and corn rallies, $1.20 to $1.50, for instance, that still leaves you with probably close to $1 rally potential in wheat, which basically takes you back to contract highs. So I think in that case, the contract high goal will be the upside target in wheat. If you end up with a situation that by the time we get through the winter and in early spring, wheat's got problems in the northern hemisphere, we haven't alleviated some of the moisture concerns, we're not getting the kind of rains that we need in the spring, things like this nature, then you've all of a sudden got a scenario where wheat can gain on corn and the upside potential is greatly enhanced. I'm not sure I expect that to happen. In fact, I probably don't expect that to happen. But from the price levels you're trading at now, wheat's got limited downside. The liquidation process got to be probably more mature than you would think, considering it basically only lasted about 6 or 7 days. But because the sentiment was so quick to be discouraged, I think the liquidation process was relatively quick to unfold here in wheat. So the wheat market is poised for some sort of a rally phase. If you look at the soybean market, I think it's more difficult to come up with a bullish fundamental storyline unless you're able to include South American weather problems or adding some what-if fear type of value to prices. The wheat market, or excuse me, the soybean market basically has broken, close to $4 from where we peaked in early September. It's been a very unrelenting break during the last couple of weeks, since the first of the month. And I think that the market is clearly flushed out of longs. I think that process happened some time ago, probably for 2, 3, maybe 4 weeks. The trade has been willing to trade the bean market from the short side. People have had concerns about Chinese demand, crush margins domestically in China, these types of things, lack of a major weather problem in South America, generally either favorable, acceptable, or improving conditions in South America. All these factors have caused people to be willing to trade beans from the short side. So you've had the liquidation processes over, you've got new shorts in the market, you've got the charts that have been largely destroyed, you've got downside price objectives that have largely been met, and while it's possible, because we don't have a South American weather problem, that we could find a way for beans to churn down here for a while and possibly trade lower than Friday's lows, I wouldn't rule it out. I'm certainly not going to bet on that. And I think that the conditions are right for a major bottom to be established here in beans as well. And I think the dynamics of beans in the South American growing season ahead of us, I think here too the mistake might be to underestimate how quickly we can turn around and the scope of the upside potential that we have. I'm not sure what that upside potential is in beans, but to think that it's not $2 or $2.50 from current levels, I think would be naive. We certainly have that much upside potential. Even if we don't actually have a major problem with South American production, if we just have a threat of a production problem, I think we can get a pretty swift rally in beans. So all of these markets have limited downside potential. They've accomplished downside objectives that we've talked about here for several weeks about trying to liquidate the market, violating certain chart points. We've done all that, and the window of opportunity for the bears is basically closed. And I think Friday's price action was very confirming in helping to set the stage for improving prices here in the weeks, well, next 3 months basically ahead of us. And now the question becomes trying to determine how much that is. So I think that we have better pricing opportunities ahead. Speculators need to see current values as buying opportunities, and producers need to feel confident that we're at the bottom end of price parameters for the next 90 days, and hopefully there'll be much better selling opportunities. And the producers need to be mindful of 2013 production and be viewing strength that occurs over the next 90 days as an opportunity to make some price sales for 2013. And for a host of other reasons, I would probably look to be relatively aggressive with those sales, but that's still probably a couple of months away. For the DPP Grain Desk, this has been Duane Lowry.